Hi, good morning, everyone. Thanks for spending your time to coming to our event here. And yeah, I think that last year is not a good year, pretty sure. Or let me just ask a question: How many of you think that last year, 2022, is a good year? If you think that it's a good year, say yes. Oh wow! It was a surprise to me. Well, so coming to 2023, how many of you year to date, after we have passed through so many months? How many of you think that 2023 is a good year? If you think that 2023 is a good year, say yes. Yeah, I think so. So I hope that 2024 or second half of 2023 will continue to be a good year. So first and foremost, it's just a very quick view of what happened in year-to-date wise. You can see that year-to-date returns, a lot of developed market is showing a divergence compared between the emerging market. If you look at some of the top lists there, Nasdaq Technology, Japan, Taiwan, US, Europe, all these markets have registered pretty awesome return, pretty handsome return. But if you look at our emerging market, China, Singapore, Indonesia, not emerging, I mean Asian market lah. China, Singapore, Indonesia, Hong Kong, Malaysia, Thailand, not really satisfying return. So what is the main issue of causing all these, all these divergence? Basically, if you look at the right-hand side, the 2022 returns. So actually, I was quite surprised. I got some of you guys say that 2022 is a good year. So, well, 2022 returns, you can see that most of the developed market registered double-digit return. But on the Asia side, we are somehow resilient, except for China. Well, I'm pretty sure that later some of the speakers will mention a lot of things about China, and hopefully you guys will gain some insight from that. So let us straight away move to our topic today, which is recommended fund. So just for information, as a research analyst here, I'm part of the investment team, and we do come up with this recommended fund on an annual basis. Well, why we come up with this recommended fund? Because we think that it will serve as it's a pretty useful tool, especially for investors like all of you guys, when it comes to the fund selection. So, in FSMOne, throughout the past few years, we have been integrating a lot of funds to our platform, and nowadays we have about 700 plus unit trusts on our platform from 29 fund houses. And I know that it's quite tough for you guys to select, so we segregate by category, including asset class, geographical sector, and we included our recommended unit trust methodology, which is quantitative and qualitative. And last but not the least, we come up with this, the 45 recommended unit trusts 2023 and 2024. So just a very quick introduction of what is our methodology here. So first and foremost, we come up with the quantitative parameters, because I know that for investors, right, it's very, very tough for you guys to predict what's going to happen in the future. But from the past, what can we indicate? Meaning that it's somehow like demonstrating the fund manager strategy to position their investment portfolio. So the historical performance is one of the consideration. Here we do consider the performance, risk, and expense ratio. So first and foremost, let me somehow illustrate about what we look in terms of performance. In performance, we not only look at a cumulative return. Basically, a cumulative means that from one point to one point, how many return you can generate from, let's say, 5 years ago to now. So if you look at cumulative return, it's somehow going to be adjusted. Let's say from 2018 to 2023. Let's say the fund just registered a very, very awesome return in 2020. Because of COVID, then it's gonna tilt the performance on a positive side. So in this case, we need to consider in the long term, is this performance gonna be sustained? If yes, then it's good. But if no, then yeah, it's one of our considerations here. Or except from cumulative performance, we do also consider on the calendar year return. It's one of the reasons that we think that sustainable consistency and resiliency is one of our crucial metrics in terms of performance. Apart from that, we do also consider a rolling year performance, which is, let's say, like the example I mentioned just now, 5 years. Let's say you bought a fund on 5 or the 4th years or the 3rd year, 2nd year or the 1st year, how many potential return you can generate from that. So this is just a very quick introduction of our performance. In terms of risk, we not only consider about a standard deviation, meaning that the volatility of the fund throughout the past few years, we do also consider the downside vol, meaning that, let's say if you so not that lucky, you bought at the peak and at the bottom how many potential losses you will achieve from that. So it is part of our consideration as well. So last but not the least, expense ratio. Probably you guys will ask us why we need to consider expense ratio in our performance metrics, since that actually the expense ratio is already included in the fund performance. Well, what I want to tell you here is this is recommended fund, meaning that we are recommending the fund instead of we are awarding the fund because based on the past performance. That's why we think that expense ratio is one of the crucial stuff to consider when we come up with this recommended fund. So with all the metrics I mentioned just now, in terms of equity and balanced fund, which we think that is more suitable for all those risk seeker, we think that performance are more suitable for them. That's why we think that 60%, we allocate 60% of weightage for equity and balance. For bond fund, because we think that bond fund is more suitable for those slightly risk-averse kind of people, and we think that 40% is a pretty good weightage. In terms of risk, we allocate 20% for equity and 30% for bond, and last but not the least, 20% for expense ratio in equity and 30% for bond fund. So next, just like I mentioned about all those mathematics, basically how we calculate this is we created a model and we input all the fund performance inside, and it automatically will come up with somehow a ranking at there. So next is the tough part, which qualitative parameters. Basically, after you come up with all these, all this ranking, then we had a very intense debate among all our investment team members here. So first and foremost, what we need to consider is a portfolio positioning. If you recall the example I provided to you just now, let's say throughout the years, the fund registered maybe a very impressive return, let's say for 100% in 1 year. So when you look at the fund fact sheet, probably, let's say, just for example, you notice that the performance is driven by just one fund, where, let's say, 50% of these holdings. So throughout the past fund, yes, the fund has registered very, very good return, very, very handsome return. But when it comes to risk, let's say if the fund make the wrong choices, meaning that you're going to be suffered the drawdown of performance because of just one holdings. Hence, I want to emphasize again, consistency, resiliency, and sustainable return is what we always trying to provide to our investors. Next, fund size and management team. Basically, fund size, let's say in order to operate a fund, you need to consider fund size. You don't need it too big, you don't need it too small. And also the management team. You don't want your fund manager to keep changes like every year, turnover is too high or what. So basically, these are some of the metrics that we consider. Of course, there are a lot of metrics out there, but this is the main 3 metrics then we consider. For the interest of time, I want to illustrate more, but too bad, because I've got only 12 minutes left. So let us straight away move to the topic, which is 89% of the funds, like Su Cheng has just mentioned just now, delivered a positive return since end June, like our call last year. Basically, you can look from the slide. Out of all the funds, only about 5 funds that registered negative return. So, yep, I know this is the main point why we are here. Basically, it's a list of our recommended fund for 2023 and 2024. Yeah, for the interest of, actually I would like to introduce all the funds here to let you guys have some understanding about all these funds, but too bad for the interest of time, I only got 11 minutes left, right? So I only can go through a little bit elaboration about what we have made the changes for this year. So first and foremost, what I want to highlight here is we have included the Core Equity Asia, which the winner will appear to be the CAF-JET fund. So maybe you guys will ask, throughout the past few years, actually we do already have Asia ex-Japan category, but why this year we need to include this Core Equity Asia? And we think that actually it's quite unfair for investors when it comes to like they want to pick Asia fund, including Japan, and if we are not recommending them, we are not doing our best part in terms of this. So that's why in this year we have included a CAF-JET fund. Just a very quick introduction of this CAF-JET fund. Basically, the fund manager adopt a very bottom-out stock picking strategy. And if you look at the fund fact sheet, it registered very impressive return in 2022, 2021. You need to note that a lot of Asia peers have suffered a lot of decline because mainly from China's side. While this fund manager, he made the right choice where he underweighted China in during that era. So that's one of the reasons of the a good performance last year. So apart from that, we do also included new players in the Asia ex-Japan category, which one of the winners will appear to be Principal Asia Dynamic Income, and also Eastspring Investment Asia Pacific ex-Japan Target Fund. For Islamic, we do have a new option for you guys, which is a Maybank Asia Pac ex-Japan Equity I Fund, while the Core Equity Malaysia, a new winner as well, CAF Core Income Fund. So if you want to ask me about what's the main difference between a CAF Core Income and also our last winner, CAF Tactical Fund, why we choose this Core Income instead of a Tactical? Basically, Core Income Fund is more concentrated portfolio compared to CAF Tactical, and it will go more compared to CAF Tactical, it will bring you higher volatility. But if you are a risk seeker, then probably CAF Core Income will be the good choice for you. Also for the Core Equity Malaysia Islamic, we do have a new winner, PNB Sharia Growth Fund, to replace the last year winner, PNB Sharia Premier Fund. So basically, the biggest changes, the biggest difference between the PNB Sharia Growth Fund and PNB Sharia Premier is the PNB Sharia Growth Fund will slightly tilt towards small cap compared to the Premier Fund, which having on a large cap last year. So next, for this supplementary portfolio, actually nothing much changes. It's just that we do have one new winner for the Greater China Islamic, where RHB Sharia China Focus Fund appeared to be the winner. Just a quick introduction of what this RHB Sharia China Focus Fund. We have spoken with the fund manager, and the fund manager have a positive view, especially in the SOE, state-owned enterprise spaces in China. So if you want to have some exposure in SOE in China, then probably you can take a look at this fund. So next, for the supplementary portfolio, we do have one new winner, which is the MAMG Global Environmental Fund, where actually if you guys do follow us very closely, probably you guys will remember last year we do have this ESG space, but we focus on the winner is Manulife Global Aqua Fund. So actually, what's the main difference between the MAMG Global Environmental Fund and Aqua Fund? Actually, it's a both feeder fund and target into the BNP Paribas. So the MAMG Global Environmental Fund is target to the BNP Paribas, and compared to the Aqua Fund, it will go more diversified approach. So basically, we think that if you are a more diversified kind of player and you are seeking some opportunity in ESG spaces, then we think that the MAMG Global Environmental Fund will be the good option for you. And last but not the least, for fixed income Malaysia, we do have M-Bond and also the Nomura I-Income Fund. So basically, Nomura I-Income Fund, we really want to recommend this fund last year, but because of this fund, it's the wholesale fund, and due to some operational difficulties, that's why we only publicly to announce it as a recommended fund this year. So I think this is the last part for our recommended fund introduction, where we do have new winner, Amanah Raya Unit Trust Fund for Malaysia Foreign Exposure Fixed Income, and also a new winner for PRS-based Moderate, which is a Principal PRS Plus Moderate. Well, let us go to a little bit chill slide. So basically, after all this introduction, let me just go into some what's the difference between a core portfolio and also the supplementary portfolio? But I want to illustrate it in a nasi lemak. Well, actually, I'm a little bit hungry because I haven't had my breakfast. Well, when it comes to nasi lemak, definitely the most important things when it comes to nasi lemak is just two stuff: nasi and also the sambal. So when it comes to investment portfolio, it actually is the same thing. When you are building your investment portfolio, you wouldn't want to, let's say, just give you an example. You are very gung-ho on US tech. You wouldn't want to have all your exposure into US tech because ultimately, when you make the right choice, you get a handsome return. But what if you make a wrong choice? Then probably your portfolio will be suffered in some sense. So that's why we think that when it comes to portfolio positioning, we suggest investors to have a core portfolio, which is on nasi and sambal. Let's say I want to build a portfolio on US side. So US is my core portfolio. I have maybe, let's say, for example, 50% of my allocation in US. But somehow I think that, China tech do have some opportunity. Then I probably want to allocate my supplementary portfolio. On the other hand, I also think that maybe ASEAN, I feel that ASEAN maybe have a pretty good return in the next few years. So I allocate some more percent into ASEAN. So these all the things I mentioned just now, like ASEAN, China, those supplementary kind of portfolio, you need to consider it as those like egg, like kacang, ikan bilis, and also the drumstick. So basically, that's how you should come up with your portfolio with this strategy. So basically, yeah, luckily I do have 5 more minutes left. So let us go to some interesting part, which is a very, very quick market outlook. So if you look at this chart, it illustrates what happened. This chart illustrates changes in terms of SPX index, the S&P 500, and also the US leading indicator index, and also the best best EPS, meaning that the earning per share, the forward earning per share for this SPX 500. So you can see that although last year a lot of people tell you about recession is coming, probably something bad gonna happen in 2023. But interestingly, you can see that throughout the past few years, the SPX in terms of price is showing an uptrend. January, if you still recall, last year, December, a lot of people are struggling. A lot of people are telling you semiconductor will have this kind of inventory issue. It's not a good thing for semiconductor. But interestingly, January, when the quarter result announcement, you can see that, yeah, semiconductor rally in January. Coming to March, we see US regional bank failure. Actually, it's not the US, it's like SVB, Silvergate, even on the European side, CS. The market has experienced a little bit of drawdown, but also the market trade view is differently because the market think that terminal rate is already near us. And coming to recently, a couple of weeks ago, you can see that even the AI frenzy, mainly driven by the very good guidance provided by NVIDIA. And also one thing I want you to note, if you look at this chart, right, basically is the US leading indicator index. Even though last year the Fed has hike their rate very, very aggressively, but you can see that the US leading indicator index actually is still showing an uptrend, meaning that the US economy is not as bad as the Fed is hoping. So definitely when it comes to investment positioning, it's gonna be very, very tough for you guys to allocate. So some people are telling you the economy is good. Some people are telling you the economy is bad. How should you allocate your portfolio? Next, the interest rate expectation has changed drastically in the first half of 2023. Some of the incidents that I told you just now are some of the like Black Swan event. And also, if you look at the long-term inflation rate, you can see that despite the cooling inflation in US, you can see that the inflation rate is cooling. The terminal rate expectation trended higher. Last year, actually not only last year, you look at the March expectation where actually a lot of people are expecting the terminal rate we're gonna be stopped at maybe 5.25. But after so many things happen, what's the terminal rate? So basically the terminal rate means that the market expectation of the interest rate to peak. So basically you can see that terminal rate is much higher compared to now. So it's pretty confused for investors. What's the things gonna happen moving ahead? So I'm pretty sure that if you do have any queries, feel free to ask our investment expert from various fund houses in a panel discussion later. Next, recession plays the crucial role next. If you look at the newspaper, every single word from those financial newspaper are gonna tell you recession here and there. So the 5 things we think that investors need to take note on in the second half of 2023. First, Fed rate. Second, the corporate earnings. Q2 gonna be announced by probably next 1 or 2 weeks. Credit after the US regional banks issue, how the banks gonna maintain their credit lending. Inflation. How sticky, how stubborn will the inflation be? And also, last but not the least, recession. Why I want to put recession in the red box basically is because all these Fed rate, corporate earnings, credit, inflation, they will only lead to one stuff, which is how severe the recession, and has it been priced in? And last but not the least, I only have 1 minute left, so I'm going to go through very quickly where the tactical opportunity is. So basically, if you follow our page closely, you will notice that we investment team, our research team, we do come up with an article very, very often. So if you want to gain some investment insight, feel free to go to our website and take a look on what we have written throughout the past few years. Last but not the least, actually on every start of the year, we will come up with this IFAS key investment team. And here's a very, very quick guideline of how we think that the recommended unit trust that we mentioned today gonna fit into our 2023 house view. So basically, first and foremost, we think that DM is more attractive than EM. So these are some of the funds that you could consider. Second, if you think that ASEAN gonna be outperformed in the next in the coming years, then yep, these are some of the funds that you should consider. Next, Malaysia. Something interesting about Malaysia. Malaysia has been underperforming for years because of the political uncertainties. Of course, I don't have an answer about what's gonna happen in the next 1 year, because you know we still have a 6-state election, we still have a global recessionary fear, so still a lot of things to consider in Malaysia. But we think that in terms of fundamental and the price mismatch, we do see some opportunity in Malaysia. Next, defensive sector resilient during recession. If you are a believer of recession going to be severe, then probably this kind of defensive sector is one of your consideration. Next, sustainable investing is now important than ever. You can't deny the fact that the ESG transition goal is a must. And if you want to take some position in ESG spaces, MAMG Global Environment Fund will be a good choice for you. And last but not the least, for equity, we do have Japan. And this is our recommended fund for Japan, which is the Aham Wood Series Japan Growth Fund. This is the last slide, which is a fixed income. We prefer the IG over high yield because of all these uncertainties, and short duration over long duration because we think that the yield, duration is the yield environment is more suitable towards a short duration. And also for Malaysia bond, we think that the yield is already kind of stable at this point of time. So we think that if you want to have some position in Malaysia bond, these are some of the funds that you could consider. Last but not the least, feel free to visit our website, fsmone.com.my, for more information. And yep, that's all for my presentation, and see you in the next session. Thank you.